Hello and welcome to interest.co.nz. I'm Gareth Vaughan with another in our series of double shot interviews where we talk to CEOs, managing directors, politicians, people we think are of interest. And today I'm joined by John Scott, who is the New Zealand General Manager for credit reporting agency Dun & Bradstreet. Welcome to interest.co.nz, John.
Thank you.
Now look, you've put out a report recently talking about the increasing number of New Zealand firms who are delaying in their bill payments. To what extent is the increase happening? How big is it? And who are the main culprits?
Look, I mean, what's happened is we do a quarterly report, an update on how businesses are paying each other. And what we've found is that in the previous quarter, the terms of payments between companies has increased to 43.9 days. Now that is effectively nearly greater, 2 weeks greater than the standard terms of 30 days. The challenge for business is the fact that it impacts on their cash flow. And so potentially, if you are not paid, you have to tap into your own credit lines or your own reserves in order to meet the obligations to keep your business operating. The challenge that we're finding now is that the global financial crisis has been gone for about 2 years now. We entered a recession a year before that, and despite all of the, I suppose, exposure to credit and the implications of managing your cash flow, these levels still remain persistently high, and that is really a cause for concern.
How much higher are they now than they were prior to the global financial crisis really kicking in sort of 2008?
Well, look, we are below the highest levels where we went up, nearly touched the 50 days area, but effectively we're not down to the low levels where we were down at 41 days or even below that. The series we've been running has run since 2001, and effectively what we're finding is that we're kind of in a sideways pattern at the moment. Some quarters it goes down, some quarters it goes up, but as I say, because of the focus that's been put on everything, we're surprised that things have remained as high as they have done.
And look, you also were saying that it was bigger companies that were the slower payers, companies with, I think, was it 200 staff or more.
Yep.
So these are pretty sizable entities. Why do you think they are slow? I mean, is this a deliberate tactic on their part, or is it just bureaucracy at work?
Well, larger organisations have a good understanding of cash flow, and they understand the benefits that cash flow accrues into their own balance sheets. But I think more importantly, these are organisations that have procedures and sign-off and levels of, I think, authorisation that have to be gone through before you actually get payment authorised and released to companies. So what you're seeing is that they have to go through that process. Also, if you don't meet their criteria, if you don't give a purchase order number, or if you don't give the related information they require, they won't pay you. So I suppose you have to conform to their requirements rather than the other way round. Also, public companies and those that are slower to pay as well. And again, the same reason, the size, the scale of those organisations. I think what this information highlights is, again, talk to those organisations and understand exactly what their terms are, how they will pay you, and if you need to get priority, ensure that you get that.
And how big of an issue do you think the slow payments between firms is for the economy at the moment?
Well, look, if we look across it, all firms that employ greater than 20 employees, their terms of trade have got worse over the previous quarter. Also, if we look at the 14 sectors we cover, 9 out of those 14 sectors have got worse in the previous quarter, and 10 out of the 14 over the previous year. So this is a concerning trend, and if you look at the economy is not yet recovering. It's sideways trending would be the polite way of putting it. Some areas are getting growth, but it's more those with deeper pockets and stronger balance sheets are able to ride out the storms, and also buy businesses that are distressed so they could buy them at a cheaper rate. So those are the factors that are doing it, rather than the overriding economy showing growth signs across the board.
Yeah, I mean, you guys have quite an interesting, view of the economy where you're sitting. And obviously had unemployment figures out yesterday that were higher than expected. We had some economists predicting at the end of last year that we were going to get 4 to 5% growth this year. You're saying the economy's moving sideways? You're not expecting big improvements anytime soon?
No, we're not. I mean, what we're forecasting, our estimated figures for 2010 GDP growth was around 2.5%. What we're saying is 2011 will be about 2.4% is our view overall, and then we'll see some increase in 2012 to around 3.3%. But look at the challenges we're facing. How much of those are imported inflationary issues, food price, commodity type price record levels, the US dollars, continued weakness, and the fact that they are just effectively pumping money into the global economy and the impact that that's having. Also, because of our higher interest rates, there is international money coming into New Zealand to chase the higher yields. So the consequence of that is, are we able to control some of those factors that are going to perhaps cause a squeeze later on? Unlike other economies such as China, where we do see inflationary pressures, 4 to 5% over the coming years, New Zealand, though, was still picking about 1.5% in 2011, 1.6% in 2012. So there, it remains, I suppose, evenly poised.
And one of the other reports that Dun & Bradstreet does that came out towards the end of last year talked about how men in particular and North Islanders were showing greater signs of financial stress than women and South Islanders. Why was that? And is this a new trend?
No, I think that there are a number of factors that underlie that. If you look at it, a lot of urban-based people in the North Island, particularly in the major population centres. And what we found is that men, when they pay the bill, they will pay the bill, but then if they stop paying that bill, they won't then come back to it, whereas women typically will pay smaller amounts but for a longer period of time. So there's a psychology behind that. Also, what we're finding is that the debt levels, whilst they've decreased since the height of the global financial crisis, they're not still back to levels that we had before the actual crisis erupted on us. So I think we're seeing trends, but it's more about a constrained economy, that people do not have the disposable income or the financial wherewithal to meet their commitments. And I think this is where we really want to talk more about financial inclusion, and the fact that at the moment the current credit reporting regime in New Zealand means that only negative information, or where people haven't met their obligations, is reported. What Dun & Bradstreet has been championing for the past 6 years is a move to a more comprehensive reporting system whereby you're able to understand someone's overall capacity and their obligations. So how much debt do they currently have, or what's the limit to their overall borrowings? What type of account have they got? When was it opened? Or if not, when was it closed? So that you can make a better understanding. Whereas at the moment, all you know is someone has inquired on your credit file, but not that you've actually had credit extended to you. This information, we know, if it's provided, will actually lead to far lower levels of bankruptcy and overall default.
And this type of information you're talking about, is it provided in other countries overseas? And what sort of response are you getting to your views on how it should be reported in New Zealand? And who's overseeing this area? Okay.
So take each of those questions in turn. International experience, probably the closest economies to look at and compare this to, it would be Japan and Hong Kong. And what you find is no single economy, there's only one actually ever that's moved from a negative reporting regime to a full positive, and that was Colombia. But most of the economies tend to take a stepped approach. And the reason behind that is to ensure that individuals, the regulators, the credit providers and the credit reporters all understand the implications of how extra information will be treated. And once people recognise that that information is respected, it's held, and leads to a better outcome for individuals, then they'll accept that there's a place for more information to be provided. But the Big Bang approach doesn't work in this area. In terms of who will regulate it in New Zealand, that is the Privacy Commission. They're the ones, they've set up the Privacy Act in 1993, they did the Credit Reporting Code Amendment in 2004, and they've updated that. And they have accepted the model that DNB proposed for a more comprehensive reporting, which means they'll take 4 additional data elements, which I've mentioned. They're also considering a 5th element, which will be 24 months of previous transaction history. So are you up to date with every payment that you've made over the previous 24 months? That they'll issue a second paper, possibly before Easter, which will give their views as to whether they'll include that when the changes come into effect as of April 2012.
Okay, so that's definitely something to watch out for.
Yes.
Now, look, Dun & Bradstreet also did some interesting work last year on the so-called Basel III, which is the global banking reforms in the wake of the global financial crisis. And you highlighted one of those wonderful unintended consequences of these types of things, which was the prediction of a big rise in the cost of trade finance for exporters, especially here in New Zealand. Now, at one of the G20 meetings towards the end of last year, they talked about how they had sort of taken this concern on board. How concerned are you that our exporters are going to face a major increase in trade finance costs?
Well, if we look at the New Zealand business economy at the moment, 80% of all companies probably produce less than $10 million in the export sector and a year. And so as a result of that, they're exporting to some of the emerging economies, and also they're a smaller exporter into those larger economies like Australia and the Far East. As a result, because terms of trade, letters of credit will become more expensive, they won't necessarily be able to access those facilities, because some of the larger banks will say, either I pass this cost on to my customers, or I'll move my funds into more profitable trading areas, therefore reducing the amount available to these instruments. I think as a result, those smaller organisations will either have to tap into their own reserves or look at other more costlier forms of finance, which will then constrain cash flow and again have that negative impact. Also, those businesses are not exporting to a diversified number of international country or destinations. They will be exposed to one or two, risky shocks. If you were just exporting, say, to Queensland and you were going into Cairns, the result of the unfortunate hurricane that's just hit them would be such that your market would potentially dry up. Now, all of those things are things that you have to take on board and assess the risk. But if it's all of your own funds going in there, the exposure to potentially one or two major shocks has increased, and that's probably our major concern about this.
And I mean, obviously, the G20, the global banking regulators have said they're going to watch this area, but they don't appear to have actually done anything to try and mitigate these concerns about trade finance. And
that's why we've effectively really highlighted this. It was a paper we released actually in October last year to talk to these very issues, and we're publicising this around the globe. And why we've highlighted it in New Zealand is that there are also some issues around Basel III that people should be aware of. Whilst obviously it's welcome that they're moving in, increasing the Tier 1 capital ratios, ensuring that large banks have the financial wherewithal to weather these big systemic shocks, there are some downside limitations that we're concerned about. One of the main ones being that this regulation doesn't touch the so-called shadow banking sector. So insurance firms, hedge funds, pension firms, who were major credit providers in their own right and who were a major factor in the global financial crisis, are not covered at all. These issues, as well as regulatory arbitrage. So we think that certain of the largest financial centres, so the US and the UK being the prime examples, will move sooner to regulate and put in stringent controls and make sure they meet these requirements earlier, which will mean that certain other countries perhaps won't move as swiftly because they are concerned about the position they find themselves in. European economies are a prime example. If that's the case, there could be arbitrage between the various regulated economies, which will mean another unintended consequence that can be exploited. So these factors have got to be weighed up, and people have got to realise what they're letting themselves in for.
So watch for the unintended consequences.
Absolutely.
Well, thanks, John, for coming in. It's John Scott, the General Manager of Dun & Bradstreet for New Zealand, and I'm Gareth Vaughan from interest.co.nz with another Double Shot interview.